Question number 1, will AI replace agents in the future? And can you license a cyborg agent? Please explain what you're suggesting.
So I'm not in compliance, so I can't explain can it be licensed. I think there's going to be a serious conversation about that because when you think about driverless cars, the reason why the technology is not where it could be is because the insurance companies haven't figured out who to blame if something happens, right? Because I think that the technology is there to actually have driverless cars on a more large scale. So I can't speak to compliance. Can it be licensed? I think that would take years for state-level regulators to get comfortable with licensing an AI. But even way before that conversation, do I think AI will replace agents? No. I think agents are still a big part of the conversation. We've seen all different technologies try to replace it, whether it be direct-to-consumer platforms. We're getting better at it. Things can be done, simpler products potentially, but when you're talking about a holistic financial plan, you need interaction. I don't see AI replacing agents. I see AI assisting agents. Having agents have better, deeper, more impactful conversations with their clients. AI picking up on things that maybe the agent wouldn't have known or didn't catch, right? So I think it's going to be a huge agent assist feature, but I don't think it replaces the agents. But at some level, we do need replacement of some agents because the universe is shrinking. So when I started in this business, there was over 500,000 agents, if not more. Now you're down to the 350, I think was quoted recently, 360. So we need something to replace all those agents that are gone. But I don't know that you would get rid of all the agents. I think through natural attrition of the industry and agent assist, you'll see AI play a role. But I don't believe AI will replace the traditional agent-client relationship.
First of all, there is this saying about almost any profession that it's not like AI will replace agents. Agents that use AI will replace the agents that don't use AI. But to talk a little bit more about this, think about travel agents and real estate brokers and like other agents that you have in other industries. AI replaces the simple tasks. Like if I need to fly from SF to Vegas, there's like 12 flights a day. I don't need a travel agent to help me book this. But if I have something way more complex, then I definitely need an agent because it's going to be super hard to do it on the app. So I think that's where you're going to have the same thing with insurance. If I want to have something very straightforward, very simple, instead of having today an agent and a form and a fax machine, I want to do it very quickly and very streamlined. But if I want to do a robust financial planning, I probably need some advices, or at least want to talk through some of my ideas and understand how to best package them. So you're going to have a combination of both.
This question is for Dror. Our group was recently in Bermuda for the Builder Conference for Life and Annuity. And to your point earlier, we do see a lot of involvement with the private equity and reinsurance companies. So you were talking about two different lapse or surrender scenarios. I was just curious as to where you're at in your maturity with a pilot to look at someone surrendering for economic reasons versus interest rate duration reasons. Thank you.
So first of all, I'm here after the session, so feel free to reach out. But to give a broader answer, I think the question was on specific use cases we have around the impact of interest rate on surrender behavior and lapse behavior. I think there are two things that the AI help us uncover. One thing is that we all assume it's the interest rate, but interest rate only explain about 1/3 of the problem. There is another 2/3, which would be the agent and the customer. So it might be, put it this way, if it was the interest rate, you would have 100% of the people hitting that category surrendering, and that's not what happened. So that's one thing. And then the second thing is that companies assume it happens around the point where the policy matures, the surrender window or like the conversion of the term or whatever. It's also not the case. It can happen in any point in time. It really depends if this is driven by the agent, if this is driven by the customer, is this driven just by the rates? By the way, if it's driven by the rates, it's the easiest one to solve. Here's a new policy with a new rate. If it's not, then you go into all of these other questions. What does that mean from a policy perspective, an agent perspective, and so on and so forth?
Yeah, we're also looking at our block, and what we're seeing is incorrect usage of the riders they might have put on it, right? So a lot of our lapses are caused by people using their life income benefit rider correctly. Like they'll pay for the option, they won't turn it on, and they'll look at the interest rate and see what they're accumulating in their pack, and they won't turn on where the real value is in their income rider. So combination of agent action, rate plays into it, but into it because of features on the product that might not be leveraged. So it goes deeper than just the rate. The rate is triggering them to see, incorrectly or correctly sometimes, see something on the policy that would make the lapse, right? So we've been studying it for 6 months now in our block of business. So it's turning up a lot more interesting things in the block.